Imagine the fear that you would feel if you jumped online to check your bank account balance, but instead of the $8 or $9 or $10,000 that you have in the account, it showed a balance of zero. You'd have that initial fear. You might even jump down to the bank and see what's going on. You talk to the bank teller and they say, I show a balance of zero as well. Imagine how that would feel. Imagine how that would scare you. Well, unfortunately, just recently, many Bank of America clients had that exact situation happen. This is an article from USA Today, and the title is Bank of America Customers Report Account Outages, Some Seeing Balances of $0. And they go on in the article to say, by Fernando Cervantes, people complain that their account balances were not visible on the app, while others said they could access their accounts, but they were still seeing a balance of zero. And Bank of America went on and told the USA Today, yes, we know this is an issue. These issues are being addressed, and by the time of the article had largely been resolved, and they apologized for the inconvenience. For the inconvenience, it's more than an inconvenience, it's a shock. And other articles went on to say that even if you went into the bank, you saw a balance. So, and I want to bring this up because it's an important point. Many of us have our bank accounts at one bank. Even if you're married, you and your spouse might have your bank accounts all at one bank. You may have your credit cards with that one bank. And it's super convenient, and I get why people do that. But we have to be careful because in today's day and age, here in the United States, we're largely a cashless society. We use credit cards. And while this situation did not result in people not being able to use their credit cards, there could be a future situation where it does. So I think it's a risk just from a convenience standpoint to have all of your accounts, all of your credit cards at one bank, despite the fact that it's super convenient. And another reason to consider having your bank accounts at different banks is for FDIC insurance. And many people are confused. What is FDIC insurance? What does it cover? And I'm going to get there, but I want to paint a picture of, what would happen if your credit card balances, your credit cards didn't work? What would happen if you could not go to the ATM and pull out money? These are all things that we take for granted, but unfortunately, sometimes things that we take for granted, they can fall apart and it can create a big headache. Now, first off, if you have an emergency fund, if you have that example of $8,000, $9,000, $10,000 in a local bank, and most financial advisors would say that you should have 3 to 6 months of living expenses really at the local bank. It's really there for convenience. It's not there to be invested. It's not there to get the highest return. It's really there to be there when you need it. But what happens if it's not there when you need it because maybe the bank has an issue? Again, we're going to get to FDIC insurance here in a second. But what if it's just a technical glitch that maybe lasts a couple weeks? Maybe you're on vacation and you're away from home and you need to pay for your hotel with your credit card. You need to pay for the gas for the drive down there on your credit card. What would happen if your credit card quit working? What would happen if your ATM quit working? Many of us, maybe have $20, $30, $40 in our wallet, and we can do that here in the United States because we're, for the most part, a cashless society now. I mean, it's super easy to survive with almost no cash on us. But we also have to plan for the unexpected, which is one reason that it may make sense for you and another family member to have your credit cards, to have your bank accounts at different banks. Okay, let's move on. What is FDIC insurance? Let's say it was a hacker, and somehow the hacker had stolen money from the bank. Now, your bank account should be FDIC insured. But what does that mean? So let's jump into it. And this is from the FDIC website, which is fdic.gov, G-O-V. and it's called Your Insured Deposits. And this was updated in April of 2024. And first, they talk about what is the FDIC. And FDIC insurance is backed by the full faith and credit of the United States government. And since the FDIC began operations in 1934, no depositor has ever lost a penny of FDIC insured deposits. But it's super important to know, when are you above those FDIC limits? Now, this is not a comprehensive talk on it, but I want to put some things on your radar screen for you to think about. So FDIC insurance basics. FDIC insurance covers deposits received at an insured bank, but it does not cover investments even if they were purchased at the insured bank. So the FDIC insurance covers checking accounts, negotiable orders of withdrawals, the NOW accounts, savings accounts, money market deposit accounts, time deposits such as certificates of deposit, the CDs, and then cashier's checks, money orders, and other official items issued by the bank. And then the FDIC goes on to say, but they do not insure stock investments, bond investments, mutual funds, crypto assets, life insurance policy, or annuities. And it used to be that banks did not also sell insurance products, but now they can. There's been this blending. So you have to be careful and be crystal clear on what's FDIC insured and what is not. Now, even if it is a standard bank account that is insured by the FDIC, we have to understand what the limits are. And the standard maximum deposit insurance amount is $250,000 per depositor per insured bank for each account ownership category. So let's break this down. It says per depositor and then per insured bank. So let's say you have $500,000 in a individual account. If that's all at one bank, well, $250,000 of that is going to be insured. And I should say, this is not financial advice. I don't know your situation, and I am not an FDIC insurance expert, but I do want you to know some basics. And that is, it's insured for the individual up to $250,000. There's also certain types of retirement accounts that can be insured in addition to the individual account for their own $250,000 account. And then joint accounts are treated separately from individual accounts. And the FDIC gives this example here, a woman named Marcy. And Marcy Jones has 4 single accounts at the same insured bank, including one account in the name of her sole proprietorship. The FDIC insures deposits owned by sole proprietor as a single account of the business owner. So even though it's a sole proprietorship, maybe your business account, the FDIC is treating that as an individual account. The FDIC combines the 4 accounts, which in this case equaled $260,000 for this example of Marcy Jones, and it insures the balance total up to $250,000, which leaves $10,000 uninsured. So it's important to plan for the unexpected. Unfortunately, just recently, Bank of America clients had something unexpected happen. I'm sure it took some people's breath away when they were trying to figure out what happened to my money. And I hope those folks are all fine and everything worked out. But fortunately, we can learn from their stressful situation. And we also want to learn from other people's experiences. And as a financial advisor for over 20 years, I've been fortunate to see other people's situations. And that's why I made this video up here. 7 things to stop doing in your 50s and 60s in order to enjoy your journey more until you get to retire. Thanks for watching this video. I'll see you in the next one. Bye-bye.